Charlotte is 62, single, just retired. Should she take Social Security? Or when should she take it, if not now? We're going to go into this a little bit. It's an interesting phenomenon. Is that the right word? Phenomenon? I'm not sure. A dilemma, shall we say, that I get a lot of emails about. So let's dive into this. This is old Charlotte, my wife. And we're going to say she has a net worth of $200,000. Just that's her investments, all right? And we're going to say, just for simplicity, people say, what about real estate taxes? What about food, healthcare? Just we're going to keep it simple. She has $200,000 of net worth, and that's going to be all in the S&P 500 index. All right, that's it. $200,000 net worth, all in the S&P 500 index. She has income of Social Security will be, how much we got in here? $2,500 at her full retirement age. She has no debt. All right, so she has $200,000 squirreled away, $2,500 at her full retirement age of Social Security, and she has needs, income needs of our. We're going to do two different times here. We're going to have $33,000 a month in her go retirement years from 62 till basically I think we have it until she's 70. Yeah, 62 to 70, and then it'll slow down a little bit from 70 on. It'll drop to $2,500 a month after that. So we're gonna have a reduction in income by what's that? $6,000, about 16% once she hits 70. When she has slow go. Sometimes I even have no go years, but in that case, we're not gonna do that here. That makes sense. So the 3,000 a month is all encompassing here. We'll include whatever property taxes she has, whatever the rent she has, however she lives. We'll include her food, her pump up the gas, include her health insurance. All right, so her health insurance will be her Medicare Part B is $135. Her Medicare Part D is $35, $40 a month, whatever it is, and then Medigap, so that's be roughly $300 or $400 a month there. So of the $3,000 a month, roughly $400 a month will be consumed by Medicare. You could say another couple hundred bucks a month for property tax if she owns her house. Maybe more than that if she rents. $1,000 a month if she rents, whatever it would be. But still, she's left with $3,000 a month. That's all encompassing for health insurance, for food, for everything. I'm going to get a lot of people who say that she can't live off that. I'm telling you, my friends, I'm just telling you, forget what those people say. I'm telling you right now, we're going to get a lot of people say, no one can live off $3,000 a month. They don't know what they're talking about. I deal with people all the time who live off of well less than $3,000 a month. That might not work for you, but for a single person who has minimal expenses, for whatever reason, it works just fine. I'm just telling you right now. You're going to see, if this is attributable to you, the scenario, you're going to see comments that say, no way you can live off $3,000 a month. I'm just telling you right now, ignore them. They don't know of what they're talking about. At least for you, they don't. Now, if you can't live off $3,000 a month, then you probably skip this whole scenario. But I'm telling you right now, I deal with a lot of people who can live just fine off $3,000 a month. All right, so I hope we're getting there so far. So we have income we need. $3,000 a month right out the gate, and then it's going to drop to $30,000 a year, $2,500 a month when she turns 70. We got $200,000 in a portfolio, fully invested in the S&P 500, and we have Social Security at 27. Was it 25? Now I can't remember what it was. $2,500 a month. $2,500 a month at her full retirement age at 67. So what does retirement look like? When should she take Social Security? Should she do any Roth conversions? And the answer is no there. But let's take a gander here, shall we? So in this scenario, she has an 87% probability of success. We have her live until 90, by the way, and leaving a liquid net worth of more than what she has right now, which is good. And that's taking Social Security at 67. So let's take a look at cash flows. All right, so she has nothing coming in. Because she's not taking Social Security. But then once she takes Social Security, she'll have money coming in when she's 67, obviously, and $2,500. Yeah, so it'll increase to about almost 36,000 a year once she takes Social Security at 67. Because she has 36,000, she's got to take out of her IRA. It will be taxed at $3,000 a year. So basically, she's going to need to come up with around $40,000 a year to live on until her Social Security kicks in. All right. So, and then once Social Security kicks in, let's see. Then she'll only need $4,000 from the portfolio, $5,000, and then once she has RMDs, she won't need anything from the portfolio because the RMDs will cover it. So let's take a look at what I want to see what the IRA looks like. Yeah, so the IRA gets down until she's taking Social Security. It goes from 200 to 175 to 118 to 84, and then Social Security kicks in and it basically levels off and starts growing again. Okay, that's good. All right, so that's interesting. So in that case, in this scenario, taking Social Security at 67 worked. Again, here's her expenses right here. So goals and expenses, the same thing. So she has goals $3,000 a month until she hits 70. Then it'll be $44,000 a year. So $3,000 or $36,000 a year until she hits 70. Then it'll be $44,000 a year. Then it'll drop by $6,000. So 6 divided by 44, it'll drop by 13.6%, which is pretty. I think that's absolutely realistic for sure. And then I'll keep going up with inflation each and every year thereafter. Okay, cool. So let's just take a look. I want to see her accounts again. So now she has required distributions. She's going to have RMDs of more than she needs, which will go right into her taxable account. So she'll have IRA distributions of $3,200, which will go right into her taxable account. Is that right? Hold on just a second. Let's just go to cash flows. Hold on a second. We want to go to cash flows. Let's see. Oops. Yeah, because by the time her expenses, so by the time her expenses drop at 71, her Social Security at that stage will be more than enough to cover the bill. So she's fine. And then her RMDs, she has no tax because she has high Social Security, a little bit of amount of RMD, and thus her standard deduction eats away any taxable income that she has. And so in this case, she'll have total inflows of $43,000, net no taxes. So she'll net $5,187, which will all go into her IRA. From her, all go into a taxable account. So that taxable account will grow. All right, cool. So that works. All right, good. Now let's go back and we're going to hit Social Security at 70 and see what that looks like. All right, so Social Security at 70 and see what we're looking at there. So remember, we got 255 in liquid assets with an 87% chance of success. Ooh, look at that. If she takes Social Security at 70, she only has a 27% probability of success, even though her liquid assets on the app or on the median go above that. So that's interesting. So the probability of having money is dropped significantly, but when she does have money, she has a lot left over to the kids. And here, right here, look at that. She has a pretty high confidence level run out of money. But if she is able to survive that in terms of not running out completely, then it'll pick back up where she leaves some money to the heirs. That's a risk that I would recommend taking, though. Look at that. So right here, she has some chance of having money, but 75% of the time or less, or more. So 75% of the time, 0 to 75% of the time, she has between nothing and $5,000. That's it. That's not enough. When she's 70 years old. When she's 73 years old, 75% of the time she has 0 to $40,000. That's not enough. Now, at the end of the day, let's go to cash flows. But again, it's always contingent on cash flows. So even though she ran out of money from a liquid net worth perspective, her cash flows are being covered still by the Social Security. You see what I'm saying? So even though she ran out of money, so to speak, she still has more than enough from Social Security to cover her. That's the current plan. Let me go to proposed plan where we take Social Security at 70. Hold on a second. Here we go. Yeah. So so what's happening here is she ran out of money, but when 70 comes around, she still has well more than enough of income from Social Security to cover her goals, and again, no taxes. And now she's building back up her portfolio again because even though she ran out of liquid assets, her Social Security kicks in, and now has a positive surplus of cash, which is going back into an investment account, her taxable account. So what you'll see, ending balance by accounts. So she has no balance right here. When she's 73, 72, 71, she's got no balance. When she's 69, she's got no balance. So obviously that's not going to work. But she ran out of money at 69. But at 70, when Social Security kicks in, she has no money. And then she starts adding to it her taxable account because she has more money from Social Security than what is costing her to live on. which is good. So that's a good place to be. I still don't like the idea of running out of money when she runs out of money at 69. So that's not gonna. We don't want that. That's not enough. Because look, at 68, she's only got $5,000 left. At 69, she's got nothing. At 68, she still needs 41,000, but she doesn't have enough from her IRA, so she's going into debt. Then at 69, she has no money. So that's not gonna work. I like the scenario there, but that's not gonna work. So let's go down here and have her taken. Can I put retirement? Let's see. I want to have her taken Social Security. Then we'll have her taken at 68. So we'll go to income and starting age 68 and see how that works. That might work better. Blink. Oh, I'm sure it's going to work better. So we'll have her taken Social Security at 68. That way, maybe not. So let's see here. That's going to be tough there. So if you have her taking Social Security at 68, she has a 71% chance probability. That's not going to be worth it. So take it at 67 for sure, just to have some liquid assets left over. That doesn't make sense. So let's go and change this guy here. Income back to taking Social Security at 67, her full retirement age. Okay, cool. All right. Now, what else I want to do here? Oh, I want to show you this. All right, so she should take her. If we didn't take Social Security early yet. So if we took it early as possible, let's see what it looks like there. I think it's going to look much less favorable right there. Probably more tax. Let's see here. If we go to tax, yeah, more in tax. I mean, look, this looks like a high. It's only 3%, and here's less than 4%, but still, much less favorable taking it early. From a probability of success, at least having money left over. But let's see about cash flows. So she took it at 63, only getting 22,000 from Social Security. Yeah, that's not gonna work. So we don't want her to take it because she's gonna run out of money. Let's go to accounts. Imagine her IRA. Oh, her IRA. No, okay, there it is. A pretty good chance that she has money left over. Let's go to analysis. Yeah, I still don't like that. Confidence. Yeah, see the money's starting to decline, and that could work. I'd much rather her take it later, frankly. Just because if she took it at 67, she's going to have enough Social Security to cover her bills, and on top of that, still have the liquid assets left. So we ran 62, we ran 68, we ran 67, her full retirement age, and we ran 70. The optimal times to take it at her full retirement age. Now, I want to show you something, though. Let's go watch this. All right, so you should spend $3,000 a month. Let's watch. I'm going to show you something here. Go to current allocation. There we go. Oh, right here. All right. Watch what happens if we increase spending. So, look, we got 87%. If we increase spending by $250 a month. That's it, $250 a month. And this is where the expenditures are so critical. It drops to 46%, and she runs out of money. That extra $3,000 a year dooms her. If we decrease that to $150 a month, and we're not talking huge amounts of money, but this is a huge amount of money for the rest of your life. You got to be on your expenditures. I just can't stress this enough. You have to be on expenditures. So what I'm doing here is I'm adding $150 a month each and every month until she dies. So $150 a month on top of her cash flows. The goal that we have here, which is $3,000 a month. So in this case, it's $3,150 for the rest of her life. Later on, it still is $150 a month added. Which is why if you're doing the right capital, I highly suggest you go into income or goals, I should say. Instead of doing retirement, instead of doing retirement expense, I would suggest you have these boxes for what do you expect your retirement year is going to be. In go-go years, the slow-go years, you can even do no-go years if you want. But the issue is when you have retirement expense, if you're 62, you're budgeting that same amount of money literally for the rest of your life. And it's just not realistic, So anyway, that's pretty interesting here. So Charlotte should take her full Social Security at her full retirement age, absolutely. 87% chance probability of success works just fine. But remember, that's just to leave money to the heirs even if she were to take Social Security when she's 70, even though she runs out of money, she still has more than enough income from Social Security to pay her bills. I mean, there's no other way around it. She still has surplus income, by the way, even though shows are running out of money. She runs out of liquid assets, but they'll be rebuilt as she goes forward. So it's just not a big deal. But do you really want to rely solely on Social Security? I don't think so. If she took it at 62, she has a less of a chance of having money left over. But even then, she doesn't quite run out of money. I mean, there's a chance she have limited amount of resources, but as she gets older and the income drops, the spending drops, she'll be able to build up her portfolio again. But yeah, it's still a little bit too dicey for me. So in this case, the most opportune time is 67. Seeing for a slow go year. That makes sense. Now, if she doesn't have slow go years, she's going to run out of money. I mean, we'll just watch this. We'll end this here. When we go to profile, and we're going to go to income. We're going to go to goals, and then we're going to say we're going to get rid of this slow go years. And what we're going to do is we're going to say stay this $3,000 a month until she's dead. Adjusted for inflation each and every month. Watch this. It's going to be freaking ugly. She's going to run out of money for sure. Yeah, 18%, because she doesn't have enough assets to pay for the increasing each and every year income that she needs. So income goes to $36,000, but she always runs deficits. And at some point she'll run out of money. So we go to accounts. Her IRA goes down to 0 when she's 80. So in this case, we got to make sure we have a good gauge of her spending and a good gauge for future spending as well. So, all right. Hope this helps. Don't forget to subscribe. I'd love to hear your comments, and we'll see you next time.